Okay, welcome to the Tilray Brands earnings. As you can see, it'll be live in just 5 minutes from now. Good morning everyone. How is everyone this morning? Lovely to see you here. Welcome, good morning, good afternoon, good evening, and welcome to the Day Trader. We go live every morning for the opening and closing bell, plus we have the breaking news of all the earnings, all the major earnings, at least all the stocks that we cover on our show. So coming up in 4 minutes time, we have the earnings for Tilray Brands. Welcome everybody. And it will be quite an explosive day today after the Fed reported yesterday. We do see that Tilray Brands has missed on earnings, but it didn't actually give an expectation either. So it's not exactly a miss, it's just lower than before. If I show you exactly what I mean, this is Tilray Brands this morning down 1.84. If we scroll down to the earnings, you can see it is down again. It didn't actually give an estimate, as you can see here, but it is down, and it's down 0.19 per share. And as you can see, it's quite a drop. That was expected. The question today is it better than expected? Did we price in? We knew that the stocks would be down. We knew that supply chain is damaged. We know a lot of materials need to come from Ukraine for Tilray, but Tilray is still the biggest company in the world in this space. So it's still the world leader. If the war ended tomorrow, Tilray Brands would go up 30-40% in like about a minute. So it's one of those things that's primed. I'm not buying any more. It's entering a very low stage right now, but there you go. Anyway, it's coming up in 3 minutes time. Sit back and relax. See you back in 3 minutes. And welcome everybody this morning. Just 2 minutes to go now, so we can pretty much fade out the music now, I think, because we are ready to go. Tilray CEO is here and we're ready to bring them on stage. So we're just 2 minutes to go now, and we invite everybody over there on TikTok this morning. All my subscribers, welcome to all of you on TikTok. If you want to join us on YouTube and take part in the debate for Tilray Brands, the link is in the profile just up here, youtube.com/thedaytrader1. Welcome. I am a shareholder of Tilray. I hold Tilray Brands. The market is down purely because of supply constraints across Ukraine right now. And we're going to clear the clock for you now because we're just moments to go before the earnings. So I'm going to bring up the link for you on youtube.com/thedaytrader1. It's going to post up here across the top of the screen. There it is. If you want to come and join us on the main show, we have our cash giveaway coming up tomorrow morning. At this time tomorrow morning, every Friday, it's our cash prize giveaway. If you want to be part of that, that's coming up tomorrow. Very, very exciting. The Tilray Brands earnings. So come and join us. We are waiting now for Tilray Brands to report. We'll bring it to you in just a few moments' time, and we are all set. Tilray Brands, just a few moments away. This is it here. We are bringing it in now. I'm just keeping my eye on it. And there we go. As soon as it begins, I will bring it to you. Not quite ready yet. We're about a half a minute away from Tilray Brands, but as you can see, Tilray Brands did drop down this morning. Basically, what we need now is we knew the earnings would be down. We knew it'd be down. Look, it's 0.19. We knew that. the thing is, it's all about going in the future. It's all about Ukraine. It's all about the war. We know that. If we get any information from the company to say that restraints are easing, and there's that, you know, the hope the war will be over. A lot of what they need comes out of Ukraine. Then things will improve. But I don't know if they're going to be able to give us that information. Of course, that's very difficult to do. But anyway, supply constraints are the issue right now. And also we have the good news. It is good news. Germany are now moving forward with legalizing cannabis anyway. The US hopefully will follow, and that's the main one. The US will follow. The whole world will probably fall in line after that. So that's what we're hoping for. If you just tuned in, subscribe and ring the bell. Let us know you are here. Give us a thumbs up. That would be absolutely great. We are just seconds away now. We're listening in for Tilray Brands. They will report any second now, and I will bring it to you. The moment they go live, you will hear it from me. We are tuned in. We are receiving the signal. We're just waiting now for it to go live. Any moment now, Tilray Brands will go live. We are listening in. And the moment Tilray Brands go live, we shall hear it. Here we go. No, Tilray Brands will go live. Here we go.
Good morning, everyone, and thank you for joining us to discuss Tilray Brands Incorporated financial results for the 2022 fiscal fourth quarter ended May 31st, 2022. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session for analysts and investment firms conducted via audio, and participating retail shareholders SPCE Technologies platform. Question submission and uploading through the SPCE Technologies platform has already been concluded, and the company will read aloud and answer the top questions. Ms. Narada, you may begin the conference.
Thank you, and good morning. By now, everyone should have access to the earnings release, which is available on the investors section of Tilray's website at tilray.com and has been filed with the SEC and SEDAR. On today's call, please note that we will be referring to various non-GAAP financial measures which can provide useful information for investors. However, the presentation of this information is not intended to be considered in isolation or as a substitute for the financial information presented in accordance with GAAP. Today's earnings press release contains a reconciliation of each non-GAAP financial measure to the most comparable measure prepared in accordance with GAAP. In addition, we will be making numerous forward-looking statements during our remarks and in response to your questions. These statements are based on our current expectations and beliefs and involve known and unknown risks and uncertainties which may prove to be incorrect. Actual results could differ materially from those described in these forward-looking statements. The text in our earnings press release issued today includes many of the risks and uncertainties associated with such forward-looking statements. And now I'd like to turn the call over to Tilray.
Breaking news, we are in recession. I called it 2 weeks ago. Anyway, here we go.
Thank you all for being with us this morning. I'm joined on this call by several key members of our senior leadership team, who you'll be hearing from shortly, including Denise Baltachek, Chief Strategy Officer and Head of our International Business, who will discuss our operational strengths across key global markets and the outlook for legalization across Europe. Blair McNeil, President of our Canadian business, who will update you on the Canadian cannabis market. And finally, Carl Merton, Chief Financial Officer, who will provide a financial update, including our progress in realizing cost synergies. Before I turn the call over to Denise, I'd like to discuss 3 items. First, the work we have done over the course of this fiscal year to optimize our global business and significantly improve our operational performance and lay the groundwork for sustainable, profitable growth in 2023 and beyond. Second, I will discuss our strategic alliance with HEXO and the important role it plays in our future growth plans. And third, our plan to generate up to $4 billion on revenue, depending upon federal legalization in the U.S. and Germany at the end of fiscal year 2024. With that, let me start off by saying that fiscal 2022 was a period of great execution and accomplishments in building Tilray Brands, world-leading cannabis CPG platform. Over the past year, we've been laser focused on optimizing our global operations and pursuing our most profitable core businesses across Canada, Europe, and the U.S. This work has included both deprioritizing and divesting lower growth legacy assets, including duplicate production facilities, while renewing investments across our four pillars, including medical, adult use, wellness, and beverage alcohol. Not only are our world-class brands and businesses in these areas driving recent market share gains and growth, but we have also entered into key strategic transactions that are bolstering revenue through improved cultivation, brand building, and distribution, while also driving productive efficiencies. The outcome of this work, as you'll hear about from the team on today's call, is evident on our performance. And to give you some highlights, we had a record year with net revenue growing 22% to reach $628 million. This reflects our market-leading position in Canada, our market-leading position in Germany, and the growth of our international cannabis sales overall by 200% compared to Q4 in fiscal 2021. And our growth in our Tilray Wellness segment with our Manitoba Harvest business, as well as the contribution from our award-winning beverage alcohol we acquired over the past 2 years. Adjusted EBITDA increased 18% to $48 million in fiscal 2022. And of note, the fourth quarter of this year marked our 13th consecutive quarter of positive adjusted EBITDA. We ended the year with a strong balance sheet with more than $400 million in cash. And very important, we delivered $85 million in cost savings, which exceeded our original target of 80, and were substantially accelerated timeline compared to earlier plans. We now expect to deliver $100 million in cost savings by the end of fiscal 2023, and we believe we'll be operating free cash flow positive at that point as well. As Carl will walk you through in a few moments, we're taking a non-cash impairment charge of $395 million in fiscal 2022, related to both market conditions and the work that we have done to optimize our operations in order to ensure that Tilray Brands is best positioned to continue to lead the global cannabis industry, and as legalization continues to accelerate. Moving along to HEXO. Our acquisition of HEXO Senior Secured Convertible Notes closed on July 12th of this year. In short, this transaction provides us with broad commercial and financial benefits, including strengthening product innovation, brand building and distribution in Canada and international markets, and eventually in the U.S. markets upon legalization, through leveraging our collective expertise and know-how and capitalizing on growth opportunities that stem from having expanded world-class CPG offerings. In addition to being immediately accretive to our earnings, financial benefits of HEXO transaction, including up to $80 million in shared cost savings synergies within the next 2 years, as Tilray will now complete production and processing products for HEXO, and HEXO will source all of its non-Canadian and non-U.S. cannabis products exclusively from Tilray. HEXO will pay Tilray Brands an annual fee of $18 million for advisory services in each of the next 4 years with respect to cultivation, operation, and production matters. Carl will discuss this in more detail. Also, I want to share that as a result of our foresight and the work we've done to optimize our business over the course of 2022, we believe we have a strong foundation upon which to achieve our strategic plan to reach $4 billion in revenue by the end of fiscal 24, depending, of course, upon federal legalization of adult use in the U.S. and Germany. As we've discussed previously, this will be accomplished by building a truly global CPG and cannabis company with a portfolio of best-in-class medical, adult use, wellness, and craft beverage alcohol brands that address the needs of patients and consumers. In achieving this objective, we are fortunate to already have many enviable attributes, each of which we sharpened over the course of fiscal 2022, that demonstrates the power of Tilray brands, including our proven brands and complete product offerings, our status as a leading low-cost cannabis producer, our strategic footprint and operational scale, our ability to accelerate international growth opportunities, our growing presence and infrastructure within the U.S. CPG market, and our proficiency in generating substantial cost-saving synergies in pursuit of long-term profitability. Of course, none of this would be possible if I was not surrounded by an experienced management team who can build upon the lessons of better for you, CPG, and beverage alcohol to execute against repeatable growth formulas within medical cannabis, adult use cannabis, adult use adjacencies, and wellness. To provide an overview of our strategic initiatives by region, in Europe we have a $1 billion opportunity based upon momentum growth, strategic initiatives, and adult use legalization. In Canada, we have a clear path to achieve our goal of delivering $1 billion in revenue. It includes working aggressively to further solidify market-leading positions in adult use, gain back market share through converting illicit consumers to the legal market, and growing our business among current and potential customers, while also continuing to bolster our medical business. Its 4 pillars include delivering continued product innovation and category leadership, investing in retail partnerships by educating budtenders through an enhanced outreach, and curating offerings to provide retailers with the highest velocity products, producing best-in-class quality products in scaled, low-cost production facilities in which we can implement synergies. And finally, as it relates to medical, expanding our relationship with patients and physicians to bolster our market position while keeping our product assortment fresh and innovative as we work to advance education and responsibility that impact regulation. Blair will discuss the Canadian cannabis market in further detail. And in the U.S., where 91% of adults say cannabis should be legalized for medical or adult use, and 60% of adults across a variety of demographic groups believe cannabis should be fully legalized, we see a market poised for growth supported by a state-by-state trend towards legalization. We believe that we can reach our target revenues by the end of fiscal year 2024 through a broad set of cannabis-focused CBG and craft beverage brands, and additional revenue in adult use cannabis pending federal legalization. Federal legalization would certainly be a watershed event for Tilray brands and the industry. But given the near-term uncertainty in seeing actual legalization reform, we're pursuing optionality, which we view as the next best thing. We have a considerable adult use adjacency through our craft beverage, alcohol, and wellness business, which include key U.S. and global assets such as Sweetwater, Breckenridge Distillery, Manitoba Harvest, which together are available in all 50 states and Washington, D.C. As we've discussed previously, our investment in MedMen during year 2022 exemplifies this approach, and we can build upon giving our strong balance sheet and leadership expertise in operations, profitable CPG businesses, and growing brands that consumers love to pursue, and additional acquisition opportunities across the U.S. Together, our growing U.S. CPG platform represents a portfolio of award-winning and highly sought-after consumer brands, a strong and robust infrastructure, a broad global distribution footprint, hands-on CPG expertise, and operational excellence. Today, our U.S. CPG businesses combined are high-margin, EBITDA and cash flow positive, as well as good adjacencies to the cannabis industry, and upon legalization and collectively, they have generated over $130 million in revenue during fiscal year 2022 and nearly $60 million in gross profit. Our beverage alcohol brands consist of Sweetwater, the #1 ranked brewery in the Southeast, and the nation's 10th largest craft brewer, Breckenridge Distillery, which recently celebrated 2 double gold and 1 gold medal in the 2022 San Francisco World Spirits Competition, the largest spirits competition in the world, and Alpine and Green Flash, which are 2 iconic West Coast craft brands. Our wellness business consists of Manitoba Harvest, which is a pioneer and leader in branded hemp-based foods. Through recent expansion, Sweetwater is now available in 42 states, including California, which is the #1 beer market in the U.S. Sweetwater also operates a new 32,000 square foot production facility and tap rooms in Fort Collins, Colorado, along with a new tap room at the Denver International Airport. The brand commands a loyal customer. Following and go-forward plans for Sweetwater include continuing to launch innovative products, a new spirit-based ready-to-drink beverages, continued westward penetration in the U.S. while expanding our presence in Canada and other international markets, improving production utilization, and evaluating strategic acquisition. Breckenridge Distillery is widely known for its award-winning bourbon whiskey collection and innovative craft spirits portfolio, including bourbon whiskey, gin, and vodka. Distribution already reached across 50 states, and the brand is able to benefit from distribution synergies when paired with Sweetwater. We are confident that this will drive growth both now and in the future. And finally, Manitoba Harvest is the world's leading hemp brand with production distribution across 17,000 stores in North America and a 50% share in the hemp seed and 15 established markets. Since the business combination, Manitoba has not only been stabilized, but has experienced dramatic trajectory change in measured channel with further opportunities to extend into adjacencies. We have also managed costs, implemented pricing actions amidst a rising input cost environment, and decreasing our reliance on big box distribution points. We will leverage these strong brands and their distribution system to grow our U.S. Tilray wellness business that will parlay it into CBD beverages, CBD personal care products, and related adjacencies. And upon federal legalization in the U.S., we'll have a clear advantage to lead in the U.S. market and strategic infrastructure operations in place to parlay into the THC-based products as well. Before I turn the call over to the team, I'd like to reiterate what we announced this morning. The company expects to generate $70 to $80 million of adjusted EBITDA and will be free cash flow positive in our operating business units in fiscal year 2023. With that, let's hear from Denise Baltichek, our Chief Strategy Officer and Head of International Business. Denise?
Thank you, Irwin, and good morning, everyone. Internationally, our strategic presence and position continues to accelerate powerful growth, and the signs continue to point to a bright future as we expand our international footprint. The European cannabis industry is heading into a period marked by widespread legalization, innovation, and considerable economic growth. According to Prohibition Partners, sales of medical cannabis in Europe are expected to be approximately 354 million euros this year, growing to 2.3 billion euros by 2026. Sales of adult use cannabis in Europe are expected to reach 1.5 billion euros by 2026, with more progressive cannabis legislation being introduced across the continent. As an international market leader, we at Tilray see ourselves as a front runner in the further development of this profitable market given our proven track record. We recognized the signs of the times early on and made several strategic investments that are now resulting in first mover advantages. Our operational strength is reflected along the entire value chain, with our leading medical cannabis brands, strong distribution network in Germany with CC Pharma, and end-to-end EU GMP supply chain, which includes 2 state-of-the-art EU GMP production facilities in Portugal and Germany, with opportunities for expansion at each facility. We are well positioned to continue to pursue international growth opportunities. In Europe today, we have one of the leading portfolios of medical cannabis whole flower and oil extract products to meet our patients' needs, and we plan to continue to build on this strong foundation and maintain our leadership position. During Q4, this unique setup led to international medical revenue increasing 205% compared to last year's Q4, but down from Q3 due to shipments in Israel in the prior quarter, which we made the conscious decision not to repeat in Q4 due to the severe deterioration of market conditions within Israel, with medical cannabis sales and pricing declining. The outlook for other international markets is more promising. Now is the time to seize the opportunities and move the European cannabis industry forward. The potential is enormous, especially in Germany as a central market, which is expected to remain the largest medical cannabis market in Europe, and should also emerge as one of the largest adult use markets upon legalization. We are already the leader in medical cannabis and number 1 in revenues in both flower and oil categories. Based on Insight Health sales data, Germany's leading provider of health industry, pharmacy, and medical cannabis sales data, Tilray has a market share of approximately 20% in Germany across our flower, extracts, and dronabinol products. And we are ready to make our contribution for the recreational market, for which we have created the best conditions. On the one hand, the operational strength of our business model, with 2 state-of-the-art EU GMP facilities, allows us to exponentially ramp up our capacity to meet the demand for medical and adult use cannabis. On the other hand, given our market leadership in the German market today, our well-established relationships with German regulators, where we have already proven ourselves to be the trusted partner, and our expertise in adult use cannabis that we developed in Canada, we believe we are well positioned to establish ourselves as a market leader to broadly legalize adult use cannabis market in Germany and seize a sizable portion of that market. This puts us in a unique position in Germany, which continues to state its intention to legalize adult use cannabis, with Germany's health minister, Dr. Karl Lauterbach, announcing that a draft bill on adult use cannabis could be published in late fall 2022. However, we believe in that instance the first commercial sale would not commence until the beginning of calendar year 2024. But also, outside of Germany, we firmly believe that Europe is well positioned to assert itself as a new hub for cannabis, with regulatory reforms across the continent progressing. Many European countries have expressed a clear political ambition to broadly legalize adult use cannabis. This is likely to be the start of a wave of change in Europe. In fact, we think all of Europe could legalize medical use cannabis within the next 2 years or sooner, with certain countries legalizing adult use shortly thereafter. A few highlights in the quarter for our international business across various countries. In France, we estimate that the French market is roughly the size of Germany. We believe that today we are serving approximately 25% of the patients within the experiment based on information provided by the ANSM. We also believe that France will legalize next spring when the experiment ends, and we are well positioned to take a leadership role there. In the UK, we have the most comprehensive mix of medical cannabis products. We also launched Pollen, a CBD lifestyle brand on Amazon UK with a mix of CBD gummies and drink drops in 3 signature lines. In Poland, I am pleased to announce that we recently received approval for our regulatory submission in Poland and will begin importing Tilray branded and white label medical cannabis products into Poland commencing in Q2. In Israel, we continue to evaluate the market and are well positioned to serve Israeli patients with the high quality whole flower products from our Portugal facility, which is CUMCS certified, compliant, in addition to being EU GMP. We have stayed abreast of the continuously changing regulatory requirements and have prepared our operations and are compliant with the regulation changes on testing that take effect in the fall. Finally, in Australia, we have expanded our medical cannabis product offerings to now include a complete range of medical cannabis whole flower to meet patient needs and are seeing great acceptance of our products. More importantly, we are one of the few providers of medical cannabis to Australia that are already compliant with the EU GMP regulations to take effect next June. With that, I'll now turn the call over to Blair MacNeil, President of our Canadian business. Blair?
Thank you, Denise, and hello, everyone. Over the last 4 years, a $5 billion legal market for cannabis in Canada has been created, which is an incredible achievement. However, this still represents a little more than half the total cannabis market in Canada, and the differential provides a significant revenue opportunity ahead. Not to mention the estimated 40% of consumers of legal age who have not yet entered the category. Still, this is a challenging operating environment, characterized by an oversupply of cannabis, unreasonable regulatory barriers, and punitive excise taxation, exacerbated by price compression. For the average licensed producer, excise is almost 1/3 of gross revenue. Despite this, we continue to see growth in the number of LPs and retail outlets in Q4. Additionally, Q4 had more new products launched in the marketplace in any period since legalization. Despite an environment of rising costs in all aspects of their lives, cannabis consumers continue to benefit from higher quality cannabis at reduced prices, while governments continue to benefit from significant taxation revenue. This is not sustainable, and we see significant consolidation on the LP front over the next 12 months. In Q4, our retail market share declined to 8.3% from 10.2% in this sequential period because of these challenging industry conditions, SKU rationalization, and discontinuation of partner brands. Our number 2 market share in Canada and leading top 5 positions across numerous adult use categories, including flower, pre-rolls, and vapes, based on recent Hifyre sales data, suggest to us that our strategies are beginning to deliver. In May, we saw the first of over 23 flower beta strains come to the market. Monkey Butter and Sweetberry Kush hit limited markets with great success. We experienced a 123% increase in forecasted sell-through and completely sold through in Q4 versus extending into Q1. We have an additional 46 strains in our Alpha program, reinforcing our commitment to a flower innovation pipeline for years to come. You will recall the majority of our share loss in FY22 was due to gaps in flower innovation, and we are confident this will reverse the trend moving forward. We are encouraged that in June, we experienced a reversal in trend and began regaining market share, a direct reflection of the flower investments we have been making. Additionally, we have been recently able to account for the gap in Hifyre data as it relates to Quebec. When we adjust for the overstatement of competitive LP share in Quebec, Tilray regained its number 1 market share nationally for the month of June. Our plan to win in Canada is based upon an integrated consumer-first approach that leverages our scale and best-in-class manufacturing to drive profitability and share leadership over time. This begins with a deep understanding of the consumer need, occasion, and functional benefit to drive our portfolio strategy of brands. Our consumer insight research project is nearing completion, which will form our thinking for brand strategy. We utilize this strategy to develop our portfolio prioritization and innovation pipeline across all product categories and consumers. During Q4, we brought exciting innovation to the market across all categories, beginning with Soleil Bites, the brand's first foray into edibles and the first ready-to-eat THC edible available at the SQDC, Quebec's sole legal retailer for cannabis products. We then expanded Good Supply's best-selling cannabis portfolio with the launch of new high-potency products, including liquid wax vapes and exclusive new flower strains available in select markets across Canada. Finally, last month, we launched CBN Night Oil under the Aphria Medical Cannabis brand. This is just a small sample of the innovation we will launch in the coming months ahead. In FY23, we expect to launch over 100 SKUs of innovation nationally, improving our innovation share of revenue to a market-leading 20% for licensed producers of our size. This consumer-first innovation pipeline will continue to identify white space opportunities for years to come. As we have consistently communicated, budtenders are a key part of our strategy. We are making investments in driving awareness through social media and digital, and educating budtenders through store visits and product knowledge sessions, while developing a CRM budtender database for focused communications. Through our market-leading coverage with Great North, we conducted almost 3,000 product knowledge sessions with budtenders on our innovation and product portfolio in Q4. This resulted in over 6,200 new points of distribution. Finally, we have a relentless focus on end-to-end costs at Tilray. Early in Q4, we identified the opportunity to optimize our cost base even further. We have put in place an additional $30 million plan, which is over and above our Tilray Aphria and our Tilray Hexo synergies. This demonstrates our commitment to managing gross margin amid an evolving retail environment. These plans are already underway, realizing $5 million in savings in the first 6 weeks of Q1. I will now turn the call back over to Carl Merton, Chief Financial Officer, to discuss financials in greater detail. Carl.
Thank you, Blair. Our results for both Q4 and fiscal year 2022 demonstrate our strength in having a diversified business across distinct operating segments, along with the traction we have made in implanting greater efficiencies into our organization despite ongoing market challenges. Before I review our financials, let me first remind everyone, for one final time, that because of the arrangement between Aphria and Tilray in fiscal year 2021, our results in both the prior fiscal quarter and prior fiscal year consist of 3 months and 12 months of Aphria's financial statements, but only 1 month in both reporting periods of Tilray's operating results. Our financial results follow U.S. GAAP and are presented in U.S. dollars. In addition, throughout our call today, we will reference both our financial results in accordance with GAAP as well as our non-GAAP adjusted financial results. Our earnings press release contains a reconciliation of our reported financial results under GAAP to the non-GAAP financial measures identified during our remarks. Beginning with the top line, our Q4 net revenue grew 7.8% to $153.3 million compared to the prior year quarter. Although, as I just said, the comparison itself is not fully apples to apples because Q4 of fiscal 2021 contains only 1 month of contributions from Legacy Tilray and does not include Breckenridge results. Our Q4 net revenue continued to be negatively impacted by the ongoing strength of the US dollar, particularly given our biggest revenue sources, native currencies, are the euro and the Canadian dollar. For example, if the average foreign exchange rate this year was equal to the rate in the prior year for the same period, we would have reported an additional $9.5 million in net revenue and reported an additional $0.7 million in adjusted EBITDA for Q4. Adjusted gross profit increased 16.7% to $50.5 million in Q4 from $43.3 million in the prior year quarter, while adjusted gross margin increased 250 basis points to 32.9% from 30.4%. We believe both of these profitability metrics should continue demonstrating improvement as more of our cost-saving programs are completed. Net loss was $457 million in Q4, compared to net income of $33.6 million in the prior year quarter. The variance is due largely to impairment, amortization, and other non-cash changes in fair values, offset partially by lower transaction costs in the quarter. Q4 adjusted EBITDA was $11.5 million, down 12.8% from the prior year quarter, extending our track record of positive adjusted EBITDA to 13 quarters. Our positive adjusted EBITDA is a function of higher contributions to adjusted gross profit from our operating business segments, coupled with our strong focus on realizing operational and other efficiencies through integration, as we have discussed over the past few quarters. Contributing to our ability to report positive adjusted EBITDA this year was the work we did achieving our synergy targets as part of the Tilray arrangement. We finished fiscal 2022 realizing $85 million of synergies towards our revised target of $100 million, of which $60 million in cash savings have already flowed through our operating results. As Irwin mentioned, Q4 is the timing for our annual impairment testing. In completing our testing this year, we dealt with a number of factors, including the impacts of expected inflation on our cost models, increased interest rates, particularly the risk-free interest rates, the strength of the US dollar against our operating currencies, and the general recessionary-like atmosphere, including current market conditions for all publicly traded companies. As a result of these factors and the changes in the market opportunities in front of us, we recorded an impairment of $395 million, split between inventory, goodwill, and other intangible assets, all offset by a reduction in deferred income taxes. The inventory provision partially related to CC Pharma, but was largely related to Aphria One as it prepares for the changes associated with its new relationship with Hexo. As you will recall, certain of Hexo's production processes are moving to our Aphria One facility, and certain of Aphria One's production processes are moving to Hexo's facility. The remaining portion of impairment, tied to goodwill and other intangible assets, related to our cannabis business segment, portions of which resulted from our ability to focus on our efforts on the best jurisdictional opportunities today. Moving to our business segments in further detail, revenue in our cannabis segment decreased less than 1% to $53.3 million from the prior year quarter. If the average foreign exchange rate this year was equal to the rate in the prior year, the revenue in our cannabis segment would have increased 4% to $55.9 million. This decrease included a 4% increase in our Canadian medical cannabis business, a 21.5% decrease in our adult use cannabis business, and a 205% increase in our international cannabis revenue. While our Canadian adult use cannabis revenue decreased, recent market share information from Hifyre for periods after year-end demonstrate our ability to regain lost market share. Regaining this share has been an almost year-long effort working on potency levels and product innovation, combined with increased presence with budtenders. During the last year, we maintained our belief that the demand for higher quality brands in Canadian adult use cannabis should rise once purchasing decisions are more positively influenced by budtenders within a retail setting. While we are extremely proud of the growth in our international cannabis revenue, the amount in the quarter could have been more. During the quarter, we were scheduled to ship approximately $6 million to an Israeli buyer. However, we chose not to ship such product as we were concerned about our ability to receive payment. Reiterating what Denise said earlier, the Israeli market has become oversupplied with cannabis from the Canadian market. We believe we made the prudent business move by passing on this order. In terms of profitability and margins, adjusted cannabis gross profit increased 19% to $28.4 million in Q4 from $23.9 million in the prior year quarter, while adjusted gross margin increased 890 basis points to 53.4% from 44.5%. The latter reflected the traction we are making through cost savings as part of our efforts around synergies. Turning to our beverage alcohol business, we generated $22.7 million in net revenue in Q4, which was 43% higher than the prior year quarter. This was primarily due to our acquisition of Breckenridge in December. However, Sweetwater contributed an incremental $1.4 million compared to last year due to its extensive new line of innovative products and increased distribution points. Looking ahead, we believe there is significant upside potential for this segment as we strengthen our position in the U.S. by leveraging our increased distribution, particularly in California, extensive innovation pipeline, and potentially other acquisitions. Adjusted beverage alcohol gross profit increased 28% to $13.6 million in Q4 from $10.6 million in the prior year quarter. However, beverage alcohol gross margins decreased to 60% from 66.5% during this period.
Our distribution business, which is overwhelmingly CC Pharma, experienced an 8.3% decline in net revenue during Q4 to $61.2 million from $66.8 million in the prior year quarter. Most of the decline was tied to the strengthening of the U.S. dollar and the inherent weakening of the euro versus the prior year period. In fact, if the euro-U.S. dollar exchange rate had been the same in the current quarter as it was a year ago, CC Pharma would have reported an additional $6.5 million of revenue. Adjusted distribution gross profit decreased to $3.5 million in Q4 from $6.4 million in the prior year quarter, while distribution gross margin declined to 5.8% from 9.5%. This decline was temporary and due to increased costs as our primary source of products were not able to ship during border closures and during periods of peak demand. We also experienced higher than normal discounts and returns during the quarter.
Finally, for our wellness segment, revenue contribution grew to $16.2 million from $5.8 million in Q4 last year, when we only had 1 month of legacy Tilray results contained within our financials. We view this business as having stabilized compared to late calendar 2020, as our new leadership team has introduced new products to the portfolio, new distribution points, and reduced the reliance on non-branded big box customers. Adjusted wellness gross profit increased to $5 million in Q4 from $1.6 million in the prior year quarter, while gross margin increased 380 basis points to 30.7% from 26.9%. Last year, we only had 1 month of legacy Tilray's wellness business. Consistent with some of my earlier comments, the reduced reliance on non-branded big box customers, as well as operating improvements, resulted in an increased adjusted gross margins. Our cash and cash equivalent balance was a healthy $415 million, while our working capital balance increased 9% to $523.2 million and allows us to meet our operational and capital requirements. Notably, we also utilized proceeds from our ATM program to strengthen our balance sheet by paying down approximately $86 million of our convertible debentures in the last quarter, and in doing so, significantly reduced our outstanding debt. Briefly moving to full fiscal 2022 results, net revenue was $628.4 million, an increase of 22% from $513.1 million in 2021. Cannabis revenue grew 17.9%, distribution revenue was down 6.3%, while we benefited from contributions from both beverage alcohol, which grew 150% due mostly to acquisitions made over this past year, and wellness, which grew 9 times to $59.6 million from $5.8 million, as we had 12 full months of contribution versus only 1 month in the prior fiscal year. On profitability, we increased our adjusted gross profit by 29.2% to $186 million compared to $143.9 million, and increased adjusted EBITDA by 17.8% to $48 million compared to $40.8 million in 2021. Included in those results were the synergies we realized from the Aphria Tilray arrangement. Of course, notwithstanding those synergies, We will also have substantial cash generation that will be forthcoming as a result of the Tilray and HEXO strategic alliance. As Irwin noted, these additional operation and production efficiencies amount to up to an additional $80 million within the next 2 years that will be shared by both parties, including our advisory fee of $18 million that HEXO will pay to us during each of the next 4 years related to cultivation, operations, and production matters. For fiscal 2023, we believe this alliance will generate close to $40 million in additional cash for Tilray. The Canadian market is right-sizing through consolidation and competitive contraction. And as this plays out, we are strengthening our position. This is being accomplished through our broader medical and adult use portfolios of high-quality strains and formats, investments in retail partnerships and physician relationships, optimized product offerings, scaled low-cost production facilities, and our strategic alliance with HEXO. This concludes our prepared remarks. We will now begin the question segment of our call, starting with questions from our covering analysts, which will be followed by a few questions from our retail shareholders through the SAY platform. Operator, who has the first question?
We are waiting for Q&A to come in. Q&A, sorry. Smash the like button there, please, over on TikTok. And if we get to 50 likes at the end, there'll be a surprise. We just lost the audio for...
Hello.
Here it comes. Here is Tilray Brands. Smash the like, guys. I have doubled my position
Operator.
on Tilray this morning. I've doubled up. I like the earnings. It came down, but very, very little, despite their earnings.
Thank you.
Their potential going forward is huge.
From Vivian Azar with Cowen and Company. Please proceed.
Hi, this is actually Victor Ma on for Vivian Azar, and thank you for the questions. So my first question, I know post-quarter the trends look better, but recent high-fire data indicates a 200 bip volume share loss in both pre-rolls and vapes in the quarter. Can you offer some color on the drivers behind this and the trends in specifically these two categories post-quarter?
For sure, yeah. I'm going to let Blair answer that. Blair, as you know, is our president of our Canadian business. So Blair, go ahead.
Yeah, there's two trends that are really driving, I would say, our pre-roll numbers and vape numbers, but both trends are different. On the pre-roll side, you're seeing some of our strain rationalization, some of our discontinuation of some brands, which will continue to be a little noisy, but our innovation pipeline will take care of that over time. The second part on vapes, what you're seeing in vapes is a rise in THC, significant rise in THC levels. Again, our innovation pipeline will take care of that, and we're very confident in the trends moving forward.
And I know, and some of the high-fire data coming out, you know, it's not, as you look at it month by month, it's not always accurate to look at it that way as the different provinces, how they take product in. So we definitely don't look at it month by month, but I will tell you, right now, last year this time, we only had a couple new products going in to the OCS. This year we have over 35 new products and more to come behind it. Our potency levels are up. Our price points are up, which we like to see. And we have some incredible programs in place to drive volume. So we feel good. And a part of this, what you're seeing too, is the Marley brand, which we, you know, took over from, you know, Tilray, is no longer, it's a discontinued brand, which was almost a $30 million business. So with that, we've cleaned up SKUs, we did SKU rationalization, and in the midst right now, we're coming up with a lot of new products.
Understood. Thank you for the color. If I could just squeeze in one more question on beer. So recent Nielsen data suggests that Sweetwater sales underperformed the craft beer category, which fell 2% in July in track channels year over year. Can you provide any color on the underperformance despite the additional points of distribution states on the U.S. West Coast?
You know, listen, the West Coast is new for us. We have one of the top distributors, Reyes, distributing our products. It's taken a little longer than we expected to go into the West Coast, but we feel really good about Sweetwater. And Sweetwater's taken a little longer than we expected, but we're happy what we're seeing on Green Flash. Nelson and Alpine, and they are existing brands. So yeah, it's taken a little longer, but I got to tell you, the opportunities on the West Coast are tremendous for, Sweetwater and our 3 other brands in that marketplace. And we have a great distributor partner, in Reyes. And what we're seeing also is other distributors that we have today picking up, Alpine, Green Flash, in the Southeast. Our United distributors just picked some of those products up. The other thing which you're not seeing, in IRI data is what we're doing in regards to on-premise, and we're picking up some nice on-premise business.
Great, thank you. I'll hop back into the queue.
Our next question is from Andrew Carter with Stifel. Please proceed.
Hey, thanks. Good morning. Well, first off, I wanted to ask, in the guidance here at the midpoint, let's just say $37 million year-over-year increase. I wanted to ask first off, is the Hexo fee included in that number? That'll be, I guess, $14-15 million. But could you also talk through kind of what you're thinking through in terms of FX headwinds, inflation, and also just revenue stability, in particular on the Canadian adult use business? Thanks.
Morning, Andrew. Yes, the Hexo numbers that I talked about in the call are all included inside of the guidance that we've given. There are a few areas where we're seeing inflationary pressures that are factored into those numbers. We're looking at rising energy costs in Germany. We're looking at rising input material costs at Manitoba Harvest. But we also have been able to secure price increases in a few places along the way, and we think that to that point we won't be adversely impacted.
And then in terms of kind of the revenue outlook, I mean, is stability for Canadian adult use, like, is the timeline for that key to this? Is it by 2Q23, 3Q? Just anything you can help us on that line.
So on that one, Andrew, I feel it's starting right in Q1, and where Blair is seeing growth already and seeing some good things happening at the same time as our new products really go into the marketplace in September. So it's not back end loaded, if that's what you're asking. It basically starts in our first and second quarter. So yeah, it's throughout the year for us. And listen, you saw what our margins are. We're not discounting our products like others just to gain share. You saw, even still, we continue to grow. So we feel good about the Canadian market and where that's going. We feel good about the new products. And listen, built into there is still synergies from the Aphria Tilray deal. Not built into those numbers are all the opportunities and synergies with Hexo. We think there's many, many more. And the Hexo ones that are built in, they don't all happen day one. They're throughout the year. So there's still opportunities for additional Hexo deals, Hexo savings.
Thank you. I will pass it on.
Thank you, Andrew.
Our next question is from Andrew Bond with Jefferies. Please proceed.
Hi, good morning. Andrew on the line for Owen Bennett. Thank you for taking our questions. So first on cannabis margins, very nice lift during the quarter to about 50%. Carl, you mentioned this was driven by efforts around cost savings. So were there any other one-time nuances or any one-time nuances or items helping lift these margins, or any seasonal considerations around cannabis margins we should be making as we forecast fiscal 23? Or is 4Q a relatively fair representation of underlying cannabis margins ex any large bulk sales? Thank you.
So, Andrew, good morning. There is a very small seasonal impact on costs. The growing season from March to May is the best growing season. It's not a huge portion of that number, but it is a small piece of that. The vast majority of the increase, though, has been driven by the cost savings programs. We talked about it in the script a little bit. In addition to the Aphria Tilray savings that we're targeting, in addition to the Tilray Hexo piece that we're targeting, we also have an internal plan inside of the cannabis business that we're targeting for further cost reductions.
And we put in place throughout the year, some initiatives, how to take additional costs out of our business. That's why we feel good, about cash flow positive, not only, in our Canadian business and our international business and our spirits and beer business. So,
market's pumping now. I predict $40,000 today on my portfolio. Tesla will hit 900, and I've just doubled my position on Tilray brands. Great. And the market did slow down, but less than last time. So things are looking up. I love it.
But, our margins will continue to increase as our volume does. And with our different mix and stuff like that.
Great. Super helpful. Thanks, Steve. Thanks, Carl. Just really quick, if I may, staying on the same theme, but for non-cannabis CPG. Now that we're entering the warmer summer months here, could you just quickly remind us of the seasonal considerations around beverage alcohol as it relates to on-premise consumption, and related to that, anything to consider?
Breaking news, Market Profit is now entering the market at $25,000 a week. You heard it first, a bear has now turned bullish. I love it. We have hit bottom. I'm all in, have been for a while.
Our bourbon, our vodka, our gin businesses, what we're seeing, some great sales right now on our vodka and gin business. There's a lot, and I'm just on our way back from Colorado. I've spent the last 3 days out there for meetings. There's some changes going on in regards to distribution there. We like what we see. You'll see in the back half, our bourbon businesses start to increase. In regards to our seasonality in beer, right now is a strong time for our beer business. And with our new distribution going into California and the West Coast, you'll continuously see, increases there. In regards to Manitoba Harvest, I got Jared Simon who runs that. There's no real seasonalities. I mean, there's a lot of the baking products and that we're coming out with, and seeds, different products. You'll see some pickup, as you go into the winter or fall months in regards to baking. From a standpoint there. And just to touch on that, hemp-infused foods, the team has done a tremendous job. What we're coming out with, new products, you heard me mention it, in my script, is pretty exciting. So we're really excited, about the contribution and the growth coming from our spirits business, our beer business, and our Manitoba Harvest. And, you heard me talk about wanting to add additional wellness products to our portfolio and additional acquisitions within the spirits and beer business. And they're exciting, opportunities for us.
Great. Looking forward to the developments. Thank you. I'll pass it on.
Our next question is from Aaron Gray with Alliance Global Partners. Please proceed.
Hi, good morning, and thank you for the questions.
Morning.
So first question. Thank you. Good morning. The first question for me, just wanted to talk a little bit about pricing, specifically around the flower category within Canada. Can you speak to, any trends specifically that you're seeing? I know you guys had, taken some price changes, a couple of months ago now. So what you kind of see going forward, if you do see some, flooring there, and if it might differentiate between different, categories of premium and value, and then just secondary on that, just your take on some asset light model that some other LPs might be taking, and whether or not you think that might be more taking advantage of the current dynamics, and that might need cultivation.
1 minute before the bell goes, it's going to be a big day. Will I hit $40,000? I've just doubled down in Tilray.
Question. The flower category is a very interesting category, and if you've looked over the last 2 to 3 years, what you've seen is the evolution of these consumer segments around value all the way to what we would call ultra premium. And so what you'll see in our beta strain program is thoughtfulness around making sure that we have entrance in all of those categories. And so while value and mainstream continue to be big set parts of the business, we do see some opportunity in premium and ultra premium, and Broken Coast is our flagship to play there. So in terms of the flower category overall, I think you have seen some flooring on it. I don't think there's much price compression to go, but there are those unique opportunities to premiumize our brands through the different consumer segments, and that is built into our flower innovation program. What you saw late in Q4 on Monkey Butter and Sweet Berry Kush launches, and then going forward, you will continue to see some significant beta strains moving forward.
And we think, in regards to, flower,
20 seconds to go before the bell goes. We will see some drops, but it will be a great green day.
Where we're seeing tremendous growth in the pre-roll category and infused pre-rolls and infused flowers. So, we see the category changing where flower used to be, 50% of the category, and that's no longer the case. But again, what I feel good about is the quality of our flower, which has improved tremendously, and also is our pre-rolls and our infused pre-rolls and what we're doing. And we're coming out with some slims. We're coming out with some new products, coming in September. So I think where we are today, we got the right mix here. And as we talked before, even, with Hi-Fire, as we've gone through our SKU rationalization and getting the right types of products into the marketplace is something that I feel good about where we are on the Canadian market.
All right, great. Thank you for that. And then second quick one for me, just on the international front. You talked about some changing dynamics within Israel that are occurring right now. But just given Israel's been a big market for Canadian LPs, as you had some, slowdown in terms of growth within Germany. Can you talk about, your outlook for 2023 in terms of, your P&L and revenue? If there's a slowdown in Israel, do you think incremental growth within the current German medical market, without expectation for adult use, will be enough to offset that, so you still see some meaningful growth on the international side there? Thanks very much.
Yep. Yeah, hi, Aaron. Thanks for the question. And so in terms of the international markets, I'm going to separate out Israel for the moment. We absolutely see growth in our FY23 numbers, both in Germany as well as other countries that have come online. As you know, outside of Germany within Europe, most of the other countries are still fairly small, but we do see growth accelerating in various countries. For instance, looking at the UK, and even though Luxembourg's pretty small, it's still a good size opportunity for us. Plus, in this quarter, we just received our market authorizations for Poland, both on Tilray branded as well as a private label customer as well. And we are looking to see some big opportunity in Poland. In France, the medical experiment ends in March of 2023, and we are expecting France to
markets
legalize
literally pumping and exploding. I don't like using that term, but I'm using it. Markets are exploding this morning. I'm going to go right through 40,000 in seconds.
And we are very confident that we'll be able to maintain a good market share there. We also see Italy and Spain also making waves and conversation about medical legalization, which we think are also big opportunities for us. You are right. We are not so bullish on Israel. We believe that there is a large oversupply in Israel caused by Canadian LPs shipping into Israel. I think what has happened in the marketplace is that as you look at product and oversupplies happening in Canada, Israel was a place where large amounts of product could be uploaded, but now that has resulted in an oversupply to that market. And what we're seeing is patients' numbers sort of stagnating and sales declining. And if you look at the marketplace there's a lot of price discounting with, special deals, 2 for 1, 3 for 1. And so therefore we're kind of hitting a little bit of a pause there and looking at what is the right strategy for that market.
All right, great. Thanks for the call, and I'll jump back into the queue.
Our next question is from Tamy Chen with BMO Capital Markets. Please proceed.
Hi, thanks for the questions. I'm just wondering, you've done a really good job at achieving the cost synergies, and we can really see that in the cannabis gross margin this quarter. I'm just wondering, going forward, in terms of balancing the cost initiatives that you have with the quality of the products, I recall when you did have that stumble in your flower quality, is it last year or something like that, there was the focus on really achieving the cost synergies, but as a result, some of the product quality, especially on flower, deteriorated a bit. So I just wanted to better understand what has changed, what changes have you made in the business so that going forward, as you're identifying more of these cost synergies that you want to achieve, that there isn't going to be a bit of a repeat in terms of quality deteriorating or just not being nimble enough to keep up with trends in the Canadian rec market. Thanks.
Thank you, Tammy, and thank you for your compliments. Number one, like I said before, yes, we've had some quality with flower. We acknowledge that. That's over a year ago. I think with automation, last year with some heat issues, in regards to ventilation, but that is 6-8 months behind us in regards to our quality. The other thing you heard me mention, just in the flower, the other thing you heard me mention is where there's a lot of change going on in the marketplace in regards to pre-roll, and that is where some of the bigger growth is coming from. So number one, yes, the team has done a great job in regards to taking out costs, but I will tell you this here, none of that has been taken out to affect quality. Number two, we've invested capital in automation. Number three, we've invested capital in ventilation in regards to, with greenhouses and the heat that we, endured last summer. So I feel good that costs are not here to hurt our quality, and we're in a good place here on regards to potency, some of the genetics that we have in place today, and in regards to the mix of the product, with some of the new products that are coming in. And, the evidence is there by the amount of new products that are being accepted by the different control boards of Tilray products.
Got it. Thank you. That was it for me.
Thank you.
Our next question is from John Zamparo with CIBC. Please proceed.
Thanks. Good morning. I wanted to start on free cash flow. What was free cash flow in the quarter? And on your free cash guide, you're not adding this disclosure of being positive in your operating business unit. So should we interpret that as it may not be positive on a consolidated basis for F23?
Morning, John. So just in the quarter, free cash flow is a pretty generally accepted measure. We burned about $26.5 million. In that, our forecast for next year is positive free cash flow for the year. And we're saying that's going to be across the business operating units. So, I'm not sure where you're getting that one or more of them might be negative, but we're forecasting positive for the year.
And John, in regards to cash built up this year, a lot of it is just as you come into our seasonality, a big part of it is just building out our inventories, as we go into some of our busy seasonal times. So that's what a lot of the cash is used for.
Okay, understood.
We're just coming to the end of the show. Markets are pumping. We're going to end this show and restart the opening bell. What a day. Get ready for this. I've already bought the bottoms in. I knew we were there. This is great. I'm finally seeing what I've been saying for a while.
You're targeting presumably $40 million in savings from the Hexo deal if you split those cost savings equally. You're now calling for an additional $30 million in cost savings. You mentioned earlier in the prepared remarks with $5 million saved already. So just can you help us kind of square all that? Are there multiple incremental costs you're incurring? Is it more that the timing of these synergies is into F24 and 23? Just anything you can help us understand that would be helpful. Thanks.
Well, number one, it's timing. Not everything starts, June 1. So, a lot of the savings and synergies are spread out throughout the year. So it's an annualized basis that we will get over the next 12 months. In regards to Hexo, some of it is interest, which is not in EBITDA. And
Tilray Brands this morning, I bought at the bottom, and I doubled my position. And boy, was that a good move?
Of building out the business here. So, yes, as we bring on some of the Hexo production, and we're just not getting.
I will answer questions on TikTok when the earnings end. Sorry, guys.
Services which will, include adding additional headcount, adding additional people here. So there's G&A offsets of some of that coming in. So number one, it's timing. Number two, not all of it is interest, which would go into EBITDA here. And three, there's offsets from additional, Hexo in regards to us adding to our infrastructure in G&A.
Okay, that's very helpful. Thanks so much.
Thank you.
Our next question is from Matt Bottomley with Canaccord Genuity. Please proceed.
Yeah, good morning. Thanks for taking these questions. Maybe this one's just for Carl. Just wondering if I could get a little more color on the $395 million of impairment charges. You listed some of the some of the factors that went into that. Is there anyone that's more of a contributing factor? Obviously, with sector valuations continuing to decline, that's something that a lot of LPs and other companies have had to deal with when it comes to how much of the severity of these impairment charges, independent of how operations are going. So I'm just curious how that factor is implementing the charge versus independent assumptions you have on growth or risk or things like that in your business segments.
Thanks, Matt. I know in your background you're a CA as well, so I know you understand this topic fairly well. First off, I just want to reiterate that impairment is a non-cash charge. Secondly, there are a number of factors that go into the calculation of an impairment when market situations dictate that, right? And so if you look at what's going on in the market right now, we're effectively in a recession if it's not formally been called a recession yet. We've got lowering stock price and market cap values for entities. You've got interest rates that are rising. A key component of calculating impairment when required to calculate impairment is what is the discount rate. Inside of that discount rate, one of the key interest rates is the risk-free rate of return, right? And so we have all of those pieces impacting our numbers. As we looked at our future cash flows coming out of the cannabis business, we also had to adjust for changing currencies. The Canadian dollar is down against the U.S. dollar. We also had to factor into the equation expectations on inflation. And so I think when you put all of those together, I would say, it doesn't really change the base beliefs of what is coming out of the cannabis division, but some of the conversion of those pieces into the calculation has caused that difference, which resulted in us taking the non-cash impairment. That's if you look at the $395 million number, a portion of it is sitting in inventory, and that was really us getting a 301 ready to take on some of the hexo production that they're going to do, as well as us transferring some of production on some products to hexo. We think about 160 to 170 million of it was goodwill related, and the rest was related to intangibles.
Got it. Very helpful. Thanks. And just one other question for me, and it's more of one of these crystal ball type questions, but specifically in the Canadian market, is there anything that stakeholders and investors can look at when it comes to potential tailwinds on the regulatory front? It looks like some of these committee meetings have been punted further down the road with respect to any changes, but when we look at how high the excise taxes are as a relation to wholesale pricing, what is now kind of a saturated, now even a retail environment, particularly in the Toronto area where I'm at. Just anything that might change for the better that maybe is out of Tilray or any LP's control, but something that you guys are hoping for cautiously.
So I'm going to let Blair answer that, but I think it's an excellent question, and we're spending a lot of time on the Canadian market. Listen, we think in regards to the number of LPs, the number of retail stores will change dramatically. With Tilray, everything is grown and produced within our facility, so you're getting consistent grow, consistent quality. You see what our margins are, you see what our efficiencies are. So, with that, I feel good about how we're positioned. I'm going to let Blair speak in a second, but he is, working with the Canadian group that is talking to the government. Sometimes you're talking to yourself when you're talking to the government in regards to excise tax. But we're out there, and it's been delayed in regards to the way the government is going to look at the cannabis market. But there absolutely has to be change to go on in that market. And if you come back and think about it, listen, cannabis has contributed over $20 billion in taxes over the last 4 years. $6 billion in building out infrastructure, over 150,000 jobs. In Ontario alone, I think it was $500 million of contribution from cannabis last year. So it's contributing a lot of tax dollars, it's contributing employment. But back to your point, about 35 cents of every dollar that we produce goes towards taxes here. So the government is doing well. We still can't advertise. We still can't go out and talk about our products. So there's got to be change. And, we're pushing for it. Blair, anything you want to add to that?
Yeah, no, what I would just say is we're very active with C3. And I would say from an LP standpoint, the group is very aligned. And we had a very successful event in Ottawa back in May. So while we don't have the crystal ball, and I know you alluded to that, certainly we do think that, as Irwin said, that we need to see some big change in the regulatory environment. THC limits are being adjusted in a couple of categories, which is a positive move. We expect to see something from Health Canada today, hopefully around CBD. Certainly there's just a lot of punitive measures going on, whether it be excise or advertising. So we continue to push really hard. I would say we're very active with the council, and we will continue to be.
Great. Thanks, all. Appreciate all that.
Our next question is from Michael Lavery with Piper Sandler. Please proceed.
We are coming to the end and we'll soon join the normal opening bell show, but markets are up big time.
I just wanted to come back to Israel. I think it was Aaron's question. I know we touched on this a little bit, but you had mentioned the potential sale and then your reluctance to execute it. But it sounds like you pointed to market conditions, maybe instead of something customer specific. Is it entirely driven by the market? And then just to clarify, when you talk about, I think maybe said it's on a pause, do you have zero sales to Israel in your guidance for this year?
We, not zero sales, but we're down on sales. Listen, I think, again, Israel is 7 million people. It was a big market. I think it was an area where a lot of sales went in there. There's three things. We got multiple markets. We sell into over 20 countries. We're looking at where there is growth opportunities.
The market is not going down. This is a morning bounce. This is expected. People are taking profits. A lot of people lost money over a long time. I'm holding. I'm not fearful. The market will go back up again. If you sell out now, you'll miss out. So that's what's happening right now.
That because what Irwin said is exactly on point about payment. Obviously we want to sell and we want to get paid too, and there has been some issues that have been experienced in the market with payment. I think also the other thing is there's a lot of changing regulatory environment in Israel where there's additional pesticide testing. There are additional requirements that are put on almost like in an arbitrary fashion. But one thing I would add, just you asked the question of whether we're factoring no sales to Israel. We are actually factoring in sales. We are looking at it strategically in a different fashion, where we would, rather than simply having bulk sales go into Israel, we are looking at it as building out a brand and building out a Tilray presence in Israel. The one thing to note, I think, which I think is important, is that from a supply chain perspective, our facility is CUMCS certified, totally compliant. We are all ready for the additional pesticide testing that comes online. So we are, in fact, ready to sell to Israel if and when we decide that it is the right market conditions and the right terms for us.
And we're one of the only ones with...
The markets will not tank today. If you sell out your stocks today, you've bought in on stocks you don't understand. The stocks will not plummet today. I guarantee it's going to go straight back up.
Sell knowing we're going to get paid for it.
Okay, that's helpful. And just would love to follow up with a portfolio question. You mentioned wanting to pursue more acquisitions in beverage alcohol. You've also talked up the benefits of the HEXO arrangement you have now and potentially how it could go further. I guess maybe how do you, is there a order of priority between two of those, and what would it take, what catalyst are you looking for, or what conditions would it take for you to want to push the relationship with HEXO further to, say, like consolidation or a bigger ownership stake in the equity?
So number one with HEXO, I think, listen, this has been a great, deal for Tilray. And again, it's a great deal for HEXO. There's a lot of sharing going on here. And you're taking, number one and number two company, and ultimately, will they come together? There's a good chance. But I think as you look at the marketplace, you look what they have and grow, what we have and grow, you look at the efficiencies, and that's what the Canadian market needs. I've always said this, there was, over 800 LPs. There's too much grow out there, and you want to be able to grow in your own facility to be vertically integrated. And what Tilray wants is to be vertically integrated on its own grow, on its, on distribution, on our brands. Today we have 12 brands. Hexo very much is not a branded company other than Redicant. It's an ingredient company. And I think the complementary, where we are very much a branded company, where we're vertically integrated on our grow, we have the distribution. And, Canada is 37, 38 million people, and you got, 2 provinces that represent about 3/4 of the, population and sales. But I think what's important here is consolidation there makes sense. No different than the consolidation with Tilray and Aphria made sense. We took, we'll take over $100 million of cost out. Just think additionally what we would take out in cost if Tilray and Hexo comes together. In regards to, the beer or spirits business, we like that business. We think it's great adjacency in regards to the cannabis industry on numerous fronts. Number one, if you look at the 3-tier system, if that's what comes into place, it's going to go through alcohol, distributors. We use Southern Glazer, which is one of the largest distributors, in the U.S. and Canada, in regards to our salespeople on the street. There's great margins in that business. I'd love to have, the multiple that a Brown-Forman or a Diageo has. That's okay. So if you think about it, there's a lot of adjacencies. The other thing is we are looking at the wellness category in a big way today, as Tilray builds out its branded consumable business. And we think, we have great experience in the wellness area, and we think there's a lot of adjacencies there in regards to our Gen Z or Gen X, and baby boomer consumers.
That's helpful color. Maybe just one follow-up. You mentioned the 3-tier system for alcohol. What gives you confidence that cannabis would be handled the same way on any federal legalization in the U.S.?
I don't have any, I don't have any confidence. I wish there's a crystal ball, but, the 3-tier system has worked well in the alcohol. It's not going away. It's been here forever. I think if you look at it, the 3-tier system may be the way it would go. And one thing today, I say this here, in our spirits and alcohol business, today we have a business that has alcohol in it. We'd love to have a business that has, spirits and beer with THC or CBD. And then we have an infrastructure of distributors today that, distribute our beer or our spirits business. So if, legalization happens, that's the case, we can put whatever, we own in the U.S. right in that distribution system, which is a big asset. No one else has that in the cannabis industry today, and that's why we want to grow that. And the same thing, if you come back and look, some of the biggest opportunities out there will be beverages that are infused with THC or CBD and food. I mean, I see what's happening just with our Manitoba Harvest business and our hemp infused. There's no reason you can't buy potato chips that are not infused with THC or CBD one day, or yogurt that has it spread on top of it. So, we have setting the infrastructure for a lot of these things to happen without knowing what's going to happen, but we will have it circled in every way.
Okay, thanks so much.
Our next question is from Scott Fortune with Roth Capital Partners. Please proceed.
Yeah, good morning. A lot of questions here, but real quick, just one for me, maybe it's for Denise on the international side. Thanks for the update on the Germany legalization progress here and the commercialization by early 2024. But what are you seeing from a competitive environment there in Germany, and what are you seeing on the pricing pressure potentially there, or what's just kind of a little bit of update on the German competitive and pricing side of things? That'd be great.
Here comes the last rinse out, people taking profits to merely buy back. You either catch it or you don't, but that's what I feel. I'm already in. I've bought the dips weeks ago, but it's your last chance. That's what I feel right now.
and are posing competition. We continuously watch the competition and stay ahead of the trend. I think one thing, first mover advantage definitely was key here. The German market is not an easy market just to enter. There's a lot of high barriers to entry. One, first and foremost, the registration for products which require stability testing, irradiation permits. That process alone can take 12 to 18 months to complete. And also we're looking at not only on the regulatory side, but we also have very high quality flower. Actually, just this morning, we received feedback on one of our strains, and it's being touted as
Robinhood
one
margin
of the top 5 strains in Germany this morning.
4.25.
So we'll continuously
Extremely cheap, the cheapest
look at our
in
market
the
entrance,
market.
and we'll continuously compete on high quality flower innovation. And I'm also watching pricing as well. Right now, we're seeing pricing that on dried flower within the marketplace could go as low as €350. We still are seeing our average pricing around the €850 price point, so we're very pleased with that, and we think that the ability to maintain pricing at that level is having a very high quality product in the marketplace. We are also obviously supplementing all of that with education of health providers and patients as well. We just launched our We Care website about a couple weeks ago, which provides a plethora of information for both healthcare providers and patients. So we continue to build brand awareness and continue to maintain high quality flower.
Here's the bounce, guys. I just said it was going to happen. It might have another one, but we're heading up today. All of those of you that feared it, you'll miss out. It's coming.
And our final question is from Pablo Zuanic with Cantor Fitzgerald. Please proceed.
Good morning, Pablo.
Good morning. This is actually Matthew Baker on for Pablo. Thank you for taking our questions. I'm going to focus on the German market.
Breaking news, Robinhood margin just gone to 5%. 5%, it is still less than anybody else in the market by a long way. I will give you the number very quickly. Fidelity is 9.85. That was last month, though. It's probably over 12. Charles Schwab was 9.8. TD Ameritrade was 11. You can add 2 or 3% to all of those, but Robinhood is now 5%, still the cheapest margin in the market.
Sure.
Yeah, I'm not sure where you got that. That is
that
the
comes
first time.
from. If the question is around adult use legalization, we also have our facility in Germany, which is right now providing medical cannabis to the German government, but there is plenty of room for expansion there in the event of adult use, well, when there is adult use. And we believe that we can provide adult use both from Germany, and we are working on the ability to provide from Portugal as well.
Thank you.
Okay, I got it. Thank you for that. And then just for my follow-up question, you guys kind of alluded to it in your answer, but in the scenario that Germany decides to only import recreational cannabis from within the EU, would you guys need to do anything to adapt for this?
Just to confirm, Robinhood is 5%, the cheapest in the market.
Today to allow for the production for adult use. We, as I mentioned too, we have the ability to expand and increase that production quite a bit. We also believe that given the fact that we were the first company to provide medical cannabis to the German government, we've developed a lot of trust and rapport with German officials. We are also currently speaking with German officials as they build out that framework for adult use, as we provide our experience in Canada in terms of what worked in adult use legalization, what has been problematic in adult use legalization. There's obviously a lot of questions, and I give
this is just the beginning for Enphase Energy, just doing deals now with Europe. America will come. The whole world will be going solar in the next 5 to 10 years. This industry is at the beginning with a 30,000% increase so far. This is just the beginning, up another 6% today.
Have 2 facilities within Europe of scale and size, and if it took additional capital and we could absolutely expand in both, have the know-how, have the ability to do it, and if we were allowed to ship GMP EU certified product from Canada, we can do that too. So we are well prepared for the European market upon legalization, and we're probably the only company that would be able to do it
Thank you for the color.
Thank you.
I would like to turn the call back over to Baron to ask the retail shareholder questions.
Thank you, operator. And the first question from the retail shareholder group is, what are you doing to stop the stock price from plummeting?
Thank you, Baron, and absolutely, a good question. I think, and I hope you heard today what we're doing. I hope you heard within our results. If you come back and look, and I just recently came back from a board meeting and presented what Tilray and previous Afria has done over the last couple of years in regards to bringing this company together. Our plan of how we want to become a $4 billion company, and absolutely that does include, legalization happening. But today we're a diversified company that is in medical cannabis, adult use cannabis, spirits and beer, and focused on wellness. We have an excellent team. We're focused big on our brands. We're focused on our consumers. And important, goes back to this question, how do we give back to our shareholders? In regards to going into next year, being free cash flow positive, being, adjusted EBITDA, increasing our EBITDA, and, building out a consumer packaged goods company that's focused on many categories and areas with adjacency to the cannabis industry. Listen, I wish I could go down to Washington tomorrow and knock on President Bush and knock on Congress and Senate and get Biden, get legalization, to happen, but we can't. I think legalization will happen over the next 3 to 4 years. And we will be set in regards to our brands, our infrastructure, and have it well surrounded. And with our balance sheet, it gives us opportunities to be out there to do different things. And I think that's what ultimately, which will increase shareholder value, which increases our stock price.
Thank you, Irwin. The next and last question is, how will you position yourself in order to enter U.S. markets?
Listen, I think.
Will I reach $40,000 today? I say yes.
We're well positioned in Canada in regards to brands, our grow, our know-how, and knowledge. We have the largest cannabis growing facility in the world today that has the ability to grow 265,000 kilos. We have 2 facilities in Europe that grow. So with that, we know how to grow. We have 12 great brands in Canada.
I've turned a negative 24% down on Tilray to down 6.5. I was down 25%. I'm now down 6.5. Fan-flippin-tastic.
This business, we have, brands and businesses with infrastructure and distribution in the U.S. I mean, Manitoba Harvest distributes products to 17,000 stores. If you think where we sell our beer business and our bourbon business today, and you look at the different distribution. So we know how to build brands. We know how to build businesses. We know the adjacencies that are out there. We have the strong balance sheet to do it. And with that, depending upon legalization, and if it's one day merging or buying with one of the current larger MSOs, we have the ability to do that. And we won't forget about MedMen, and have an optionality on MedMen is something we have that upon legalization, we could go ahead and acquire MedMen, which has a strong brand name that can be used in, multiple products throughout the U.S. So we have it circled. And let me tell you, it's difficult running a business with a lot of unknowns out there that are dependent upon regulation. But I think what we're trying to do is build out infrastructure, build out areas upon legalization that we can pull it all together. Thank you. So with that, that ends our call for today. It's been a tough year, 2022, in regards to COVID, in regards to closures in the Canadian market, in regards to having vaccine cards to enter stores, in regards to trying to keep a workforce together, in regards to inflation, in regards to, changing out a lot of our grow, integrating Afria and Tilray together with the savings, acquiring, our Breckenridge business, acquiring Green Flash, Alpine businesses. And, I think we've accomplished a lot in regards to what we are able to do. We built out a very, very, very strong management team that can take Tilray to, the next level. Our, deal with Hexo and joining with the number 2, LP in Canada. And with that, I think we're well set and well positioned for a strong 2023. Listen, we don't like where our stock is, just like everybody else. The market conditions, I think, we're in some tougher times. But with that, Tilray has definitely tightened the belt. We've taken cost out. We're well positioned on our balance sheet. We're well positioned on our cash. We're well positioned in regards to our margins. We're well positioned on our grow. We got a good diversified business here. So I'm excited about where we're going, and I'm excited about what we can do. And last but not least, we are focused to return to our shareholders and what we can do with that. So with that, enjoy the rest of your summer, and thank you very much for joining our call today. Thank you.
There we go. So fantastic. I doubled up. I like the earnings. I can see where that's going in a few years from now. Fantastic. I doubled my position. I originally said I wouldn't buy any more. It's not something that interests me. I'm not a smoker. I wouldn't smoke cannabis. I don't smoke regular tobacco. I don't smoke anything. But I like making money, and I see this as as an absolute exploding business in the future. I was down to only 25% this morning. I'm down now to 6%, and I've doubled my position. Very, very happy with that. Very, very happy. The markets are going to go up today. I'm going to hit 40,000. It's a market for the brave, and it has been now a market for the brave for a number of months. Right, we're going to reset the show. We'll be back in just a couple of minutes' time. Okay, we'll be back in a couple of minutes' time for you with the opening bell. Of course, the bell is already gone. So we'll see you back in just a couple of minutes' time as we reset this show. Thank you very much for being here. Don't go anywhere. Stay right where you are on the channel. I'll be back in 2 minutes for the opening bell. It's going to be a phenomenal day. I'm very excited. I've doubled up. I've got more Meta. I doubled up on Meta. And I am more bullish than ever. I always am, because I find the opportunities. See you back in just 2 minutes. Bye-bye for now. Take care of yourselves and each other.